Let's talk uranium. Lately, spot uranium prices hit the highest since 2024. However, despite all the fanfare about AI-driven demand for electricity and the need for new nuclear plants, the metal was something of a laggard last year. Sprott, the big ETF provider, says it rose about 11% in 2025. But copper was up, for example, more than 40%. Let's get more from Jonathan Hinze, president of UxC, the provider of consulting services and data to the nuclear sector. Thanks very much indeed for joining us, Jonathan.
Thanks, Andrew.
We have a long-term chart of uranium, so prices are up, obviously, substantially in the past few years. Interesting, though, that it was a relative underperformer last year, uranium.
That's right. We had a pretty big spike in 2023 to 24, probably a bit of an overreaction, given the response to the concerns over a ban on Russian imports in the U.S. and also in Europe. And so we had a correction last year, and the market was a bit on the lower end for much of the year last year. But it did continue to rise in the latter half of last year of 2025 with Sprott. You mentioned their physical uranium trust raising more money and buying quite a bit. But, you know, the reality is that the spot market isn't the only market in this industry. There's a long-term contract market, and the price of the long-term contracting actually saw a significant increase last year. And so that's where the utilities, the actual end users of uranium, buy their uranium. And so that was a notable change last year, was that the term contract price actually rose above the spot price. And that's a sign that there's a fundamentals kind of story building here in this market.
Yeah, because as far as I can see, early in the century, uranium spiked and the term contract price hit a record high. And it's pretty well back to that record high now, as far as I can see.
Yeah, we're not all the way there yet. $95 was the highest term price we ever published as our company. But I think we're getting close to that now. We're getting close to the 90s. And we could surpass that record if the market continues to trend upwards. You know, the real reality is in that the contract market, by 2029, 2030, we're looking at a potential structural deficit in this market with the need for new mines to come online. And so the long-term price is really the incentive price that mining companies look to lock in for future profits. And so that's why we're seeing the move there. And I think utilities are starting to notice that they have to contract. Otherwise, they might be left out in the 2030s with not enough supply to be had. So that's the real market right now. The spot market is exciting and volatile, as that price chart just shows you, driven a lot by the financial entities and trading companies and the like. And, you know, they tend to move in tandem, the spot and term markets. So, you know, it's a rising tide lifts all boats type of situation here.
But from what you're saying, we're not actually in a supply crunch for uranium yet. People aren't getting extremely worried.
I would say we're not there yet. We do have enough uranium to be had right now if we look at both inventories and the actual production side of things. That said, you mentioned the AI at the outfront. You know, if all the demand that's being sort of talked about and will be building with both reactors restarting here in the US or in Japan because of more demand for power, as well as new reactors, especially in China and elsewhere, that demand is just going to keep rising. And right now, the supply is not keeping pace with that. So in the near term, and I'd say the next 2-3 years, we're not in a supply crunch yet. But if I look out just 3, 4, 5 years from now, we could really get into that deficit situation. And that's where the market is now focused on. And the prices are also reflecting that future supply gap forming.
Jonathan, we'd better leave it there. Thank you very much indeed. Jonathan Hinze, president of UxC.